All right, so let's continue. We just ended at 40, so we are continuing from 41. So 41, the Fisher's effect is defined as the relationship between which of the following. So the answer for this particular one is C, real rates, inflation rates, and nominal rates. So 41 is C. It's G. $42. Which one of the following relationship is stated clearly? So the core price must be equal to the par value. An increase in market rate increases the market price of a bond. Decreasing the time to maturity increases the price of a discounted bond, all else equal. And D, increasing the coupon rate decreases the current yield. All else constant. So the answer to this is C. Decreasing the time to maturity increases the price of a discount bond. Right, the answer is C. 42 is C. $43. Green Roofings Green Roofings is preparing a bond offering with 6% and a semi-annual coupon and a face value of 1,000. Okay, 6% semi-annual coupon and a face value of 1,000. The bond will be repaid in 10 years and will be sold at par. Given this, which of the following statements is correct? So 43, the answer is C. The bond will sell at a premium if market rate is 55, because looking at here, the bond will become discount bond if market rate declines. That's false. The bond will pay 10 interest payments each of that. That's wrong, because this is going to pay it's a semi-annual coupon, so it is going to pay more than 10. It's going to pay 20, right? 20. And then the bonds will sell at a premium when this is true, because the coupon is 6%. If the market rate changes to 5.5, then it means that coupon is higher than the yield to maturity, making it sell at a what? At a premium. The bond will initially sell for now. So the answer to this question is C. 43 C. 44. Grand Adventure Properties offers a 9.5% coupon bond with annual payments. The yield to maturity is 11.2%, and the maturity date is 11 years from today. What is the market price of this bond? Right, so we can solve this here. So coupon rate is 9.5%. So meaning that coupon is going to be 95. So 95, putting into the formula, 1 minus into brackets. R here is what is R? R yield to maturity is 11.2%. So 1.112. Just doing it as faster. Minus 11 all over 0.112. We've done this already here. like we know this formula already here on this channel. So I don't have to repeat the formula and do everything one, otherwise you'll be wasting 10,000, which is the face value, all over 1.11211. And this is going to give us, this is going to give us 895.43. Which is answer option A. Answer option A. So 40, 45. The corner Lusa has 7-year 6% annual coupon bond outstanding rate 1,000 par value. The bond has a yield to maturity of 5.5%. Which of the following statements is correct? If market yield suddenly increase to 6.5%. So now let's calculate before and after. Before it will change. So seven years, 6%, 5.5. So 60 before. Before 6% is going to give us 60. 1 minus into bracket 1.055. Raised to the power negative second. Oh, this headache is really worrying. Oh, about 0.05 plus the face value is 1,000 all over raised to the power 7. And with this, we are going to get 972.3. Then now after the same thing, 60. 1 minus into bracket 1.065. I need just 65. Yeah, 0.65. So it changes to 65. So 0.65 raised to the power negative 7 all over 0.06. Here is negative, here is positive. Right, so here we are going to get 1028. Right, so now let's compare the answers. So the answer is first, they are saying the bond will increase by 59%. Let's check. Let's check the increments. If we want to check the increment, then we are going to do it this way. So increment 9 to the 972, sorry. Sorry. So 1028 minus all over 972 because 972 was the first price before it changed. So this is going to give us, so sorry, times 100. This is going to give us you have to be fast when it says otherwise this will take all your time. This is going to give us 5.76. Right, 5.76%. And then they are saying that the bond will increase by 5.29%. No, I'm not sure. Because we had the 5.76. All right, so this is supposed, so I'm not really getting the answer here, but on the marking scheme, I'm getting an answer of C, right? 4.5, 5 point. Let me check something here. Let me even rank class. How to supposed to do it. I think I've interchanged it. I've interchanged it. Yeah, I've interchanged it. So here is what I'm supposed to be. That's how I go from it. Here is what I'm supposed to be 9 seconds. And then I mean like here is what I'm supposed to be 1028. So everything is going to be like this instead. This is going to give us 72 minus 5028 over 128. So it was minus. So we are seeing a decrease, right? So according to the answers I've solved, I was just checking. I didn't know how I got this. Okay. So I forgot how I. So now here said it will increase, but we are seeing negative, so that is wrong. And the bond price will decrease by this. When we check, it's decreased by 56. That is the top side. Here, when you check how it will decrease, 972 minus this is giving us 56. So this is making this also wrong, right? And then the bond price will decrease by 5.43%. And then the bond price will decrease by 5.36%. The answer here is C, 5.43%. The reason why I'm getting this 5.44 is because I didn't round the figures. I'm supposed to get 972 point something. I didn't bring this thing. That's why I'm getting this. So the answer to this question is C. The answer is C. Then 47. Mary just pitches a 46. Sorry. 46. Mary just pitches a bond which pays 60 a year in interest. What is the 60 called? It's called coupon. So number 46 is A. Number 47. All right, so number 47. Capital budgeting involves budgeting for long-term capital expenditure, budgeting for long-term operational expenditure, budgeting for market expenditure, budgeting for employee salaries. But the answer here is C, which is I only. Capital budgeting only involves budgeting for long-term capital expenditure. Right. So C. The discount rate used in the net present value method has an inverse relationship with the net present value. Number 48 is C. Number 49. The internal rate of return is defined as the discount rate which causes the net present value of a project to be equal to 0. So 49 is D. If a firm accepts project A, it will not be feasible to accept project B. Both projects will require the simultaneous and exclusive use of the same piece of machinery. These projects are mutually exclusive, right? So the answer for 50 is C. C. The modified internal rate of return method addresses a drawback of internal rate of return by adjusting for unequal projection. So, and adjusting for unequal project duration. So, number 51 is G. 51 is G. Rosita Restaurant is analyzing a project that requires 18,000 of fixed assets when the project ends. Those assets are expected to have an after-tax salvage value of 45,000. How is the 45,000 salvage value handled when computing the net present value of the project? So reduction, no. So cash inflow in the final year of the, so it is here. So it is added to the cash inflow of the final year. That's it, because you sell it at the end of the year. That's why. So 52 is B. Samosin Electronic has required a payback period of 3 years for all of its projects. Look at it too. They require a 3 years payback of all the projects. So they are not looking of other alternative or anything. Currently, the firm is analyzing two independent projects. Project A has an expected payback of 2.8 years and a net present value of 6,800. Project B has an expected payback period of 3.1 years with a net present value of 28,400. Which project should be accepted based on the payback decision rule? Based on they are not saying based on the net present value, but based on the payback decision rule. So we are only accepting project A. So the answer to this question is A. 53 is A. Which of the following are considered weakness in the average accounting rate of return average accounting return method of project analysis? So the answer to this is B, which is I, exclusion of time value of money from it doesn't use time value of money. And then I even is based on accounting values too. And accounting values can either be how do I even put this one? It can be either be cash or on credits, right? So that's what it means here. So 54 is B. $55. A project produces annual net income of 46,200, 51,800, and 62,900 over 83 years, respectively. The initial cost of the project is 65,000, 675,000. Sorry. This cost is depreciated straight line to a zero book value over 3 years. What is the average accounting rate of return if required discount rate is 14.5%? Remember that this discount rate is just here to confuse you, because we've already stated here that accounting rate of return does not consider time value of money, right? It doesn't include time value of money. So exclusion of, so here we are not going to use a discount rate. So let's solve for this. So accounting rate of return ARR right, is equal to the average net profit. Average net profit. I'm shortening this. Average net profit all over average investment or average cost of investment. Right, so the average net profit here in this situation is, so let me shorten this, average net profit is 46200. So 46200 plus 51800. So all the profits, we are summing on the 46200 cost is average divided by the number of plays. We are going to get 536.53. So now average investment cost. Investment cost is going to be the average investment, which is 375,000 divided by 3 because it's 3 years. It is going to give us 225,000. Right, the zeros are 3. Take notes. So now what we are going to get is, so now ARR is equal to 53633 divided by 225,000, and we are going to get 0.2383, or let's say 84. Which is approximately 23.84%. 84%. Right. So that is it. So now So the answer to this question is T. 55 is T. And 56. Which of the following statements which of the following statements related to the internal rate of return are correct? So the answer here is D, which is basically the internal rate of return that causes the net present value of different projects. Sorry, let me reread it again. So the internal rate of return that causes the net present value of differences between two project cash flows to equal 0 is called the crossover rate. And also, IFN rate is both the timing and the amount of project cash flow affect the value of the project internal rate of return. So both, basically what IFN is saying that both the timing and then the cash flow affect the IR because it changes. Sometimes you can have the same cash flow amount but different time, so you will see that the IR will change. Yes, the like. So the answer here is the 56 is the 57. All right. So you are considering following two mutually exclusive projects. The required rate of return is 14.6 for the first one, project A, and the second one is 13.8%. Which project should you accept? So meaning that we are coming to accept the one that has the highest NPV, right? So project A, if you want to get the NPV, right? We are going to uh, find the net present value of the cash flows, right? So the first amount is 28400. Because it's 14.6%, so divided by 1.146 plus the second year, which is 36200 all over 1.146 raised to the power 2 plus the third one, which is 21000 over 1.146 is the power 3 because it's the 30, all minus the initial cash flow. Initial cash flow is 50,000. Right, so in doing all this, we are going to get we are going to get 16298. Here's for the first one. So the second one too, we are going to do right. So let's look for project B. So B is going to be 41,000 all over the discount. It has a different discount, so 1.138 plus 20,000 all over 1.132 plus 10,000 all over 1.133 minus 50,000. Right, and then we are going to get 8256. So we can clearly see that right. So we can clearly see that the first project is having a higher NPV than the second one, right? So they say we should accept project C because it has a higher recovery rate of return. No, that is wrong. And then project B, because NPV is about 4,900 more than the NPV project of B, because B has the largest total cash flow. So the answer here is B, right? The answer here is B. When you do the difference, you see that it is B. But I don't really. We know we are selecting project A because it has the highest NPV, and the NPV is about this and this. When you subtract the first NPV from the second NPV, you are going to get that difference. I think time is far gone. Let's continue quickly. 57 is B. 58. Based on the profitability index we showed, a project with the following cash flow be accepted when the discount rate is going to, okay. So what you are going to do now is you are going to find the present value of 1,000 11,800, and then find the present value too for this one using this discount rate. Right, then you divide it by this initial outflow. Right, and then I'm sure you are going to get. Realize this. So this thing here is 11,800 plus. This one is okay. So 11,800. 1.14 plus 24 4 9 and by 1.14 right, and then here is the third year. When we do this, we are going to get we're going to get 2 7 1 5 7.6 and then the lights. So now remember, for profitability index, it is CI is equal to N, present value of cash flow all over the initial cost of this thing. So initial outlay. Also, so present value of the cash flow, we are having 2715.7.6. So let's divide it by the initial outlay, which is negative. So which is 26200. 26200. Which is going to give us 1.036, also equal to 1.004. So the answer to this is B. So the answer to this is B. Yes, the profitability index is 1.04. So now, stock 59, stock A and B each have an expected return of 15%, a standard deviation of 20%, and a beta of 1.2. The returns on the two stocks have a correlation coefficient of 0.6. Your portfolio consists of 60% of A and 50% of B. Which of the following statement is correct? So basically, let's only look at, okay, so A is saying that the portfolio is expected to return 15% here, because since it is 50%, 50%, we're expecting a 15% here. Portfolio standard deviation is greater than no, it's not greater than 20%, as we are seeing here. Because this standard deviation can either move up or down, and then the portfolio standard deviation is greater than 20%. Okay, portfolio beta is greater than 1.2. Portfolio beta here is 1.2. Portfolio standard deviation is 10%. So this 20% here can either go up or come down. So the answer to this is A. So 59 is A. So 60. Let me move fast from there. So 60. Assume the risk-free rate is 6% and the market risk premium is 5%. Given this information, which of the following statements is correct? So if a stock has a negative beta, its required return must be negative. No, that's not necessarily true. That's not necessarily true. And B, an index fund with beta 1.0 should have a required return of 11%. A, an index fund with beta 1.0 should have a required return less than 11%. That's also not true. So the answer here, the answer to question 60 is G. An index fund with beta 1.0 should have a required return of 11%. This is because this plus this minus multiplying by this will give you 11%. That's why. So number 60 is G. Remember the formula for this thing already. That's why I don't want to see it. So 61. Which of the following statements is correct? If there is free rate into 61, the answer is D. The slope of the security market line is equal to the market risk premium. So my 61 is D. 62. Assume the risk-free rate is 5%. Which of the following is correct? 62. The answer is C. If a stock has a negative beta, its required return under the CAPM will be less than 5%. Yeah, because if it has a negative beta, the other side will be negative now. The risk-free now, subtracting from the risk-free will have less here. So 62 is C. Which of the following is not a form of dividend? So number 63 is B. A sale of a company's used vehicle to a shareholder. '64. Risk of two securities with different expected rates of return can be compared with A. The coefficients of variation, how they vary. $65 and more. Dash is a situation where one firm buys assets or shares of another. This one there, please put the answer in the comment section. Please put the answer in the comment section. We know this already. All right. The answer is B, acquisition. This is perhaps the greatest management motive for a merge is the synergistic effect. That's the synergy, right? So number 66 is A. The synergistic effect, that's the synergy. 66 is A. All the following are true about stock acquisition, except the stockholder vote is required. No, stockholder vote is not required. So number 67 is T. $68. An acquisition whereby the target company board objects to takeover offer is called a hostile takeover, a fienipa. That's all the way to be a fienipa. Fienipa. Number 68. See, a fienipa hostile. See hostile, haha. 69. Each of the following is not a type of merger acquisition, right? This is a linear merger. We don't know that one. 69. 69 is C. $70. Acquiring company can use all the following except company name. Who the company company. Number 70 is G. Company name. You can't use company name to all the company name for it. Because of it. Let's take it. That's it. Any other 71. When EcoBank Limited merges with the Trust Bank (TTB), what kind of merger was this? Was in the slide, right? This is called horizontal merger. They are doing the same activities. So horizontal merger. It's a measure or measure. I'm able to be a 72. A tender offer is an public offer to directly buy shares from the shareholders of another firm. So number 72 is A. I think 73. The most preferred cash flow for merger analysis is the free cash flow. The free cash flow. Free cash flow was A. $74. Dash is an extremely lucrative severance package that is guaranteed to a company's senior management in the event that the firm is taken over and managers are let go. This is the golden parachute. As I say, golden parachute. 74. 75. Dash is the company for which another company is seeking to direct a takeover bid. Is the target. On any dinosaur. Ban when you dinosaur on your target. So this is the company from which another company. So you are targeting some. So that's the same thing. So this 75 is A. All right. This comes to the end of solving 2020. Let me see. This comes to the end of solving last year's past question, 2023 past question for business finance 2. I'll try possible best and see if I can also do the same thing for business for the 2022 one too. Yeah, I'll try my possible best and see. So after 10, I'll also report and then post. If anything, let me know. In case there is any mistakes or any correction, you can correct me or prompt me in the comment section so that I can also learn, because I also learn each and every day. If I've made any mistake in any of the answers too, you can let me know so that I correct them. All right. Thank you very much for today. Nehemiah here. Sign out. Peace out.